Welcome to the debate. Today, we are focusing on what many consider the definitive financial inflection point for high earners, your 30s. This decade is often branded the acceleration period. Income truly advances, assets start to accumulate rapidly, but, and this is critical, so do major structural liabilities like high-end mortgages, education savings, and just the overall cost of a complex modern life.
Right. It's really the highest stakes decade. The window for truly exponential compounding is wide open, but the consequences of a serious misstep are, they're no longer theoretical. We're moving from playing with monopoly money to dealing with real significant capital.
Exactly. And that transition from, let's say, building to managing leads us right to our core question. At this juncture, where material wealth is finally being realized but high vulnerability persists, should the primary financial strategy become fundamentally safer, prioritizing capital preservation, or should it become more aggressive, focused solely on maximizing the velocity of long-term outcomes?
Well, I contend without reservation that if you have decades of runway left, the priority has to be maximizing compounding velocity. The time horizon grants us the ability to absorb volatility, and the opportunity cost of playing defense now is a far, far greater long-term risk than any temporary market drawdown.
And I will argue that this is precisely the moment the primary objective shifts from getting rich to staying rich, requiring the vigorous protection of the accumulated financial moat. Safety isn't just a defensive posture, it is the necessary foundation that ensures the successful completion of the entire wealth journey. My core perspective is that as soon as a portfolio reaches a substantial size, say 6 figures or more, the primary risk just changes. It's no longer about small setbacks that delay the start of saving. It's about structural, ruinous setbacks that can undermine the base capital entirely. This defensive shift is necessary because many high earners operate within a highly rigid financial system, burdened by what I call compounding liabilities. These aren't just student loans anymore. We're talking about jumbo mortgages with high fixed costs, the steep property taxes in high cost of living areas, and just high-end lifestyle expenditures that are very, very difficult to cut quickly. These fixed costs dramatically shrink the margin for error. So, protecting this emerging financial moat, therefore, is paramount. We have to implement a comprehensive, protective mindset. This strategy involves formal risk transfer, adequate life insurance, crucial estate planning, and a robust liquidity buffer. A fully funded emergency fund, say 6 to 12 months of those steep fixed expenses, isn't just a nice to have, it's a shield. This moat prevents you from being forced into what we term dollar cost ravaging, that catastrophic scenario where external pressure, like a job loss or a medical crisis, forces you to liquidate investment assets at depressed prices during a market downturn, locking in losses and structurally reducing your compounding base forever.
I see why you emphasize that protective foundation. And look, I agree that avoiding ruin is essential, but that focus on defense fundamentally undervalues the single greatest asset this demographic possesses: time and peak human capital. I hold that the most significant risk in your 30s and 40s is the long-term opportunity cost of inaction over a time horizon that still stretches 20 or 30 years. When we look at the simple century-long math, the average returns of equities just dwarf those of cash or conservative fixed income. To shy away from that equity risk premium now is to sacrifice millions in terminal value later. Furthermore, we have to properly diversify total wealth. For many of the highly skilled professionals we're talking about, a tenured professor, an established specialist doctor, or a corporate partner, their future income stream is incredibly stable, almost bond-like. Because their human capital already acts as a low-volatility fixed income anchor in their total wealth, their financial portfolio should be weighted heavily toward high-growth, high-volatility assets to achieve true diversification. Aggression, in this context, means high equity allocations, 80-20 or even 90-10, and consciously tilting toward assets known for strong growth potential, things like small-cap stocks or emerging markets, to maximize those peak compounding years.
That's a compelling argument, though I would frame the stability of human capital very differently. You mentioned the long time horizon allows for recovery, which, yes, is mathematically sound if you never have to touch the principal. But you have to concede that high fixed costs seriously undermine the theoretical capacity for risk. You're treating human capital like some indestructible, perfectly liquid bond, but it isn't. It is subject to black swans, loss of licensure, industry disruption, burnout, or a prolonged health crisis. And if that income stream falters simultaneously with a market downturn, this high fixed cost demographic immediately faces severe sequence of returns risk, or SOR. While SOR is typically discussed in retirement, it applies equally here if forced withdrawals occur. Liquidating assets early to service those compounding liabilities locks in losses. It creates that structural setback we identified, dollar cost ravaging. Protection is the bridge that ensures you never have to sell when the market is at its nadir.
I'm just not convinced by that line of reasoning because it exaggerates the relevant risk for accumulators. The danger of SOR is, I think, wildly overstated for people still actively contributing capital. Even if you faced a scenario where you lost your job and the market dropped 30%, the 6 months of emergency withdrawal needed to cover expenses is likely a very small single-digit percentage of the total portfolio you've built over a decade. The emotional and tangible cost that is far more relevant for the high earner in their 30s is the regret gap. This is the demonstrable gap between the wealth you actually achieved and the wealth you could have achieved had you maintained an optimal aggressive allocation. That regret manifests as years added onto your working life simply because you prioritized psychological comfort over the mathematical reality of growth potential.
When you are 20 years out, the regret of missing the 2010s bull market because you were sitting in too much cash far outweighs the temporary pain of a small forced sale during a bear market.
That pivots the discussion perfectly to the great debate around liquidity itself. You talk about missing out on upside, but the cash reserve, that war chest, is not a missed opportunity. It is a purchased option. It grants you asymmetric upside with very limited downside. That optionality might be a career pivot, the capital needed to start a business, or the ability to swoop in and buy assets when everyone else is panicking. You cannot quantify the value of that optionality on a spreadsheet.
Okay, liquidity as a purchased option is a compelling phrase, but we have to discuss the explicit, quantifiable cost of that option. Holding excessive, six-figure sums in a low-yield cash account is the silent killer of wealth. Let's just look at the numbers. If you hold $100,000 in cash, earning 2% for 25 years, you end up with roughly $164,000. If that same capital had been invested even conservatively, yielding an average of 8%, you would have over $684,000. That difference, over $500,000 of terminal value, that is the concrete price of the cash drag. Furthermore, in a persistent high-inflation environment, holding cash is a guaranteed loss in real terms. You are prioritizing the emotional peace of mind over the rational preservation of purchasing power.
And I acknowledge the cash drag calculation is mathematically robust. The solution, however, is not to eliminate the protective shield, but to innovate how we finance it, especially for those with high assets. I agree that keeping 6 months of expenses entirely in cash might be inefficient. Instead, high earners should leverage alternative liquidity options that don't suffer from severe cash drag. I'm referring to mechanisms like asset-backed lines of credit, ALLs, or home equity lines of credit, HELOCs. These allow us to maintain access to capital, often hundreds of thousands of dollars, without having to liquidate appreciated assets or hold large sums in low-yield cash. An ALL, for instance, uses your existing brokerage portfolio as collateral, allowing those assets to continue compounding while providing immediate access to funds, potentially within 2 business days. This strategy effectively separates the protective function from the drag, maximizing both growth and safety.
That's a highly sophisticated strategy. And yes, it addresses the cash drag problem, but it introduces what I see as a fatal flaw regarding safety. Relying on lines of credit assumes credit availability remains constant, but history shows us that banks cancel or drastically reduce the available balances on HELOCs and LALs precisely when economic factors turn against you, when markets are crashing and unemployment spikes. The worst time to accumulate debt, even low-interest debt, is when you are facing a forced, sudden job loss and the inability to service that new loan. The purchased option you advocate for can be rescinded at the exact moment you need it most. That's structural uncertainty. It can't be ignored.
That vulnerability touches directly on our third point, the ultimate role of behavioral psychology in portfolio construction.
The mathematically optimal portfolio is utterly useless if the investor can't stick with it. The right portfolio is the one the investor can endure through good times and bad. If an aggressive 80-20 allocation causes sufficient psychological pain, if the sleep well at night factor is compromised, and that leads to emotional decisions like panic selling during a 30% drawdown, then your mathematically optimal strategy becomes the inferior choice. Behavioral endurance and the avoidance of catastrophic behavioral errors must always trump academic optimization. It protects the investor from themselves.
I agree that behavioral discipline is paramount, but that defense-first mindset often suffers from what's called the end-of-history illusion. People consistently underestimate how much they and the world around them will change in the next few decades. The 30-year-old is planning for a future self they don't yet know, a person whose risk tolerance might actually increase as they achieve financial independence earlier than anticipated. If you build too defensively now, you might deeply regret the lost growth later, because loss aversion, the pain of a loss being psychologically greater than the joy of an equivalent gain, has led to paralysis. We have to build flexibility into the plan, and that flexibility is best funded by maximizing aggressive growth during peak human capital years. Working longer than needed because of overly conservative choices in your 30s is a permanent, irreversible consequence of behavioral caution.
Navigate the inevitable volatility without making irreversible mistakes. The cost of one behavioral error, panic selling 50% of your portfolio, outweighs decades of optimization.
And the cost of decades of conservative allocations outweighs the temporary correction of one or two bad sales. The market recovers, lost years of compounding do not.
To summarize, my perspective emphasizes achieving control. The safety strategy built around protecting the moat and carefully managing compounding liabilities ensures that the balance sheet is a fortress, largely immune to external shocks. This means career and lifestyle choices are dictated by preference and aspiration, not by financial pressure created by high market leverage.
And my perspective emphasizes achieving leverage. The aggression strategy uses peak income and time to exert maximum pressure on the compounding equation, pursuing what I call wealth multiplication as quickly as possible. This approach maximizes the terminal wealth value, fundamentally buying back the ultimate prize, time.
Both paths are, of course, credible, evidence-based approaches. They reflect deeply different assessments of which risk is most consequential, the risk of loss or the risk of missing out.
Ultimately, the choice reflects a fundamental trade-off that the listener has to confront. Which risk will they regret more in 20 years? Losing a portion of what they have already built? Or not pressing for maximum growth when they still had decades of compounding ahead?